So Marketplace just came up with a video and an article describing how the big 5 Canadian banks
We're going undercover. And of course, we're going to have hidden cameras rolling at Canada's big 5 banks.
aren't acting in the best interests of their clients and are actually misleading and in some cases lying to clients and customers.
I'd explicitly told them that they didn't want any sort of loan protector service that they offered me.
Kind of noticing that we had kind of high bank fees.
$95 a month for a useless insurance policy has caused me quite a bit of grief.
It's not really much of a surprise to me, as I kind of been preaching all along that this is why you need to become your own financial advisor. So basically, Marketplace went undercover and began talking to employees who didn't want their identity revealed because for fear of repercussions/terminations, describing how they have been forced to upsell and push products onto customers and clients that they know aren't in the best interests of those clients.
We've heard from current and former employees of the big banks who tell us there are targets to hit.
Marketplace actually did a similar thing back in 2017 where they did the hidden camera thing. We're talking to customers, employees, how they felt about their investments. So they did this thing again 7 years later. They tried to talk to customers, to employees. So the results are actually quite shocking.
It's a high-pressure sales environment.
We had high expectations for sales quotas.
We're encouraged to push our targets over clients.
And we've been hearing from you about banks pushing products you don't need or never asked for.
Employees were quoted as saying, even though I'm paraphrasing, that they felt 100% pressure to push investments and accounts onto clients when they knew it wasn't 100% in their best interests. They felt this pressure from upper management to meet their sales because that's how the banks make their targets and continue to generate revenue for themselves.
And I felt like I'm putting them in a worse position.
And what's worse, he says colleagues added products to customers' accounts without their knowledge.
Many times because they needed to meet their sales targets.
A client walked in and was looking to make an investment of $50,000 into the bank and asked, well, what fees am I looking at? What am I charged on? And the bank, 4 out of 5, incorrectly said that the bank only charges fees on that gain of $5,000 if they were to gain $5,000, and they won't be charged on the full $50,000 of the original investment.
We're asking about the fees charged on those mutual funds. What will advisors who have to sell mutual funds to hit targets tell us about the fees? At BMO,
take it out of your returns. Yeah.
This is incorrect. This is clearly wrong. When you make an investment into a bank, you are charged fees on the full lump sum. You're not just charged fees on the profit you make. How do I know this? Well, because you're also charged fees if, say, your portfolio loses money. You pay regardless if your portfolio makes money that year or not. You'll often hear financial advisors boasting and bragging about how they generated a 15% return in one record year. What you'll very seldom hear about is how they underperformed for many years, but continue to charge that 1 to 2% management expense fee every year, even though they underperformed. You are still going to pay fees based on your original investment. This is what I've learned from my years of study of personal finance and investing. Only 1 in 5 of the bank employees got it right. And even then, they were really kind of wavy on knowing the terms and how the fees are actually applied.
At Scotia, the advisor claims he doesn't know how the fees work.
I heard they only take it out of the gains. So let's say if your 50,000 grows to 55,000, that 5,000 gain extension, that's where they take the 2% out of. I'm not too sure how they calculate it.
Banks will often push investments, opening accounts, things you don't need because, well, it's great for the banks. That's how they make their money. So they'll say to potential clients just looking to withdraw some money or have questions about their investments or credit cards or the fees, oh, don't worry about the fees. They won't add up to much. In actuality, when you're investing, the fees can add up to a substantial amount.
At TD, we're told not to worry about the fees.
A lot of clients won't even notice because it's very insignificant.
We're also told incorrectly they're only charged on any profit.
Will that 1.9% also be taken from the
50,000? Or
No, it's not taken out from your own principal.
Customers recognize that they're being gouged and that the banks are adding on fees and hiking interest rates really quickly and sometimes excessively.
I actually had my own similar struggles as well. You walk into a bank and, well, you're not sure on all the products, exactly what it does, how it works, how to invest in them. So you kind of rely on the bank advisor to give you that information, to tell you the best investments. So you're kind of at their mercy regarding some things. I don't expect everyone to be their own autonomous, independent advisor and know the ins and outs of everything. You couldn't possibly. I actually did a video a few months ago called 4 Amazing Reasons Why You Should Become Your Own Financial Advisor. I'll bring that up for you right here. A financial advisor is said to look out for you to manage your portfolio and maximize your returns. That's part of the requirement for a job. However, their true loyalty lies with the bank or whatever institution they work for.
Name of the game, move the money from your client's pocket into your pocket.
Here's a true story about how my wife and I want to consolidate our debt. We went to a very well-known, well-established Canadian bank. We spoke to a young kid, he was about 25 years old. And after meeting with him, discussing on the best rate, how to best consolidate it, as we were wrapping up our conversation, no word of a lie, he, well, maybe this is part to meet his quota, said,
"Well, would you guys be interested at all in a visa?"
"What?" "Well, considering we just consolidated our debt, we came to see you to get our debt down. We're not really interested in a visa," we're thinking. My wife and I were dumbfounded. We looked at each other and then just looked at him and said, "No, we're not really interested. No, sorry." Why would you offer us a visa when you know we're trying to consolidate our debt? It makes no sense. I couldn't fathom how this entered his head, but then after thinking about it, oh yes, he has certain quotas, standards to meet. He's not really looking out for us primarily. He's more concerned with himself and representing the bank and their interests.
That you finally found a broker on Wall Street that you can trust and who can consistently meet you. Sound fair enough?
Banks will push traditional mutual funds onto most people because they bring in the highest fees for the banks, even though there is no real evidence to suggest that they perform better than the trusted index fund would.
Do you think the pressure to sell products was behind some of the advice we got?
Almost all of the advice that you got, I think, was influenced very heavily by the pressure to sell financial products.
Employees have said that they feel pressure and fear being fired and have bumped up credit cards, overdraft, or account types just because of these pressures, and told false stories, lie, to sell products. I had to mislead customers into getting products that they didn't need to reach my sales target.
The sales credits BMO employees get for selling things like checking accounts, credit cards, and lines of credit. The more money the bank makes, the more credits the employee earns.
Now, don't fool yourself. The big 5 Canadian banks have a very strong push in the Canadian economy. They made over, together, $55 billion last year, and they have pretty strong leverage over our government and what happens in our economy. They definitely have a say in what goes on. These pressures are actually not allowed in the Canadian Banking Act because they're not allowed to provide false or misleading information to customers or the public, or take advantage of a person. The Canadian Banking Association has come out with a similar comment as well, saying that it doesn't believe the banks were acting in the best interests of their clients. Chrystia Freeland, our Minister of Finance, was asked to comment on the situation. Of course, she declined.
Minister Freeland, this is CBC Marketplace. We're hoping to speak to you about a story we're doing about sales pressure.
Our objective is to protect Canadians by ensuring their financial institutions treat them fairly.
What kind of a show are you guys putting on here today?
However, remember, just like Morgan Spurlock said in Super Size Me,
bottom line, they're a business, no matter what they say.
Their number one job is to make money. Many employees, when they're interviewed for this, most of them know that they're making these mistakes. Other employees Well, they just don't know any better. They either don't have the education like some of us, they don't have the proper training. There's a variety of situations and scenarios.
Those frontline advisors don't know the answer.
However, some of the employees and financial advisors that are making these recommendations, they make the same mistakes in their personal life. Maybe they tell you one thing because that's what they do, even though it's incorrect, because they just don't know any better. How often when you walk into a bank, do you hear, "Oh, hello, Mrs. YouTube. Guess what? You qualify for a credit limit increase," or "I can open an extra account for you. Don't worry about it. No, there's no charges at all." Until you start reading the fine print or you notice on your bank statement, all of a sudden you're dinged with fees. Oh, we didn't mention you have to maintain a minimum $6,000 balance. It's always those fine print that they trust you not to read or ask the right questions about, and then you're on the hook because you've already signed the name and the onus is on you for not having read it. But you can say, well, it wasn't explained to me properly. Well, in another scenario on Marketplace, a person was told, well, paying down your debt is good to a certain extent, but take the rest and don't pay off the debt. You should rather invest it because you can earn a guaranteed return.
You don't have to pay out all of it, but definitely pay out a portion.
Yep, just pay off a portion of that debt. Invest the rest. Bad advice, says certified financial planner Sandy Martin.
You cannot earn, I can tell you 100% unequivocally, you cannot guarantee a return on a mutual fund or any stock. You cannot guarantee a certain level of return.
There is no way that you can make 19.99% on your investment. It just won't happen. Of course, you should pay your credit card debt off.
That is totally 100% wrong, and they know they're not supposed to do that. You cannot tell what the stock market is going to do, how a fund is truly going to perform. That is totally incorrect. You should almost always pay down your debt first, because that is a guaranteed 5 to 10, whatever your credit card interest is, ding, that you're going to pay interest for. So that is guaranteed. Your investment income is not guaranteed. You don't know if it's going to go up or down.
The advisor does not get paid to pay off the debt.
You don't get any sales points.
No, I don't get any points for that.
As for that inheritance, all the advisors recommend investing in mutual funds that earn them sales credits.
Of course, the bank is going to say, oh, don't worry about that credit card. Why? Because that extra money, those interest and fees, well, that's coming to the bank. So, oh, well, leave a good balance on there. That won't hurt you. No, this is incorrect.
Pay down your debt.
This is actually really hurting Canadians saying, well, don't worry about your debt now when we're in a cost of living and housing crisis. Like, this is the worst time I think someone could hear that. A similar story actually occurred in the US in 2016 with Wells Fargo, in which it was revealed that employees had to keep opening up fake accounts without the knowledge or consent of many customers due to upward pressure from management to keep generating and bringing in revenue for the bank. There is actually a Netflix docuseries loosely based on this Wells Fargo's ordeal called Dirty Money, with stories of scandals and corruption. It's actually pretty good. Hey, real quick, if you feel like you're getting something out of this video, would you do me a favor and hit the like button, as it tells the YouTube algorithm I made a pretty decent video that's decent and that people are enjoying watching. Also, consider subscribing if you want to learn about personal finance and investing from a 20-year Canadian corporate accountant. It's almost like they value salesmanship and presentation over knowledge, that you don't have to know a ton about investing and personal finance as long as you can sell and communicate and bring in that revenue. Now, from what I've seen online and through numerous videos, it's not absolutely horrible advice that always is being recommended by these financial advisors, but it does show that the bank does lean more towards bringing in revenue than putting the client's needs above their own.
So, to be clear, do you feel you're under pressure to get customers to make financial decisions that may not be in their best interest?
100%.
I actually happen to know quite a bit about personal finance and investing. Well, I should hope so. I made a channel about it, being a 20-year corporate accountant. So I can actually push back when I hear incorrect information and correct people. This is why I'm a big advocate for becoming your own financial advisor, or at least gaining some investing and personal finance knowledge. I think it's so important, it's not taught enough in schools, that people are aware of how money works, the basics of investing. Am I expecting you to rebalance your portfolio and start stock trading? Of course not, no. But if you know enough that when you're talking to financial advisors, you can say, whoa, stop, hold on. That doesn't sound right, or no, that's just blatantly incorrect. You are in a much stronger position to catch mistakes, to be able to handle your personal finance and investing. Now, I'm not saying that all financial advisors working at banks are bad. There's actually some really good ones out there, and their reputation shouldn't be tarnished because of a few bad apples. But it's actually up to you to do your due diligence, because no one, like I said, will care for your money and investments as much as you do. And that's a fact. So what can you do to protect your investments and look out for you? So 1, ask about their credentials. What courses, certifications, degrees, or designations do they have? You can actually check them out for yourself with this link here. I'll leave it in the description below. You simply type in their name and it will pop up if they are registered with Canadian Securities. Are they commission-based? That depends on how many accounts I open and the amount of money I bring in. Or are they performance-based? And it depends on how well my investments perform. These are questions you want to arm yourself with and ask. Ask that financial planner about their credentials. Do they have a degree in finance and accounting like I do? Do they have certificates in financial services advice, estate planning, retirement strategy, or designations as a personal financial planner or certified financial planner? And famous courses such as Canadian Securities courses and investment funds in Canada. This will help you determine if they are legitimate and have the required education, and also help prevent you from being a victim of fraud. Now, every financial advisor is different, so this is what I do. Number 2, are they actually listening to you? Are they taking into account your financial situation? Are you comfortable in understanding what they are explaining to you? Does it make sense? Are they just throwing around terms that you don't understand and you're kind of lost? Are they opening accounts that you don't really feel comfortable with, or not properly explaining the fees associated with those accounts? Banks make money by overdraft protection, opening accounts, opening credit card accounts, lines of credit, and everyone's favorite, mortgages. That is how banks make their money. So they always want to be bringing in new money to keep that revenue increasing each and every month. I'm sure there are countless stories of how people used to regard banks as, well, I'd go and see them and they were part of my neighborhood, the people that worked there, and I'd not only go in there to open accounts, but lean on them for financial advice, see how my investments are performing, but also what I should do, how I should handle my retirement, tips. So there's a level of trust that's been inherently ingrained into Canadians for years, and it's kind of damaging now to hear and see this from the big banks, that level of trust has kind of eroded now. And now people are like, well, I don't know if I should even trust the banks. Like, can I even trust them? Who do I go to? There are so many great reputable institutions out there, credit unions, insurance companies, other banks. And it depends, like I said, on what financial advisor you get. Many of these banks, it depends on the level of competence, their credentials, their education, their level of integrity. So don't just dismiss all the banks and say they're bad. That's actually not true. There are many good advisors out there. You just have to seek and find the one that's right for you. Or like I said, become your own personal financial advisor, or at least have some good insight into your own personal finance and investing. I've always recognized the irony that I say, be careful who you listen to, what you read online, who you take advice from, and yet I have a YouTube channel and I'm telling people, listen to me, take my advice, or at least consider it. What I want you to do is become so well informed that you're able to discern and choose good advice from questionable advice, from bad advice, so you're able to recognize the difference. If you're interested, I have 2 more great videos here about personal finance and investing. I talk about all things money related.